You ever look at a company's financial report and just see a wall of numbers? It can feel pretty intimidating. Well, what if I told you those numbers aren't just math? They're actually a language, and today we're going to break down how to speak it. You've probably heard this phrase thrown around before, right? But it's not just some catchy slogan. It is the core idea that unlocks how any organization, big or small, communicates its health, its performance, and its potential. Honestly, understanding this language is crucial for anyone who wants to know what's really going on inside a company. So what is accounting at its heart? Well, it's a super structured process. It's about taking every single financial event, I mean everything, from selling one cup of coffee to a multi-million-dollar merger, and translating it all into a clear, understandable story. Okay, so let's dig into why this language even exists in the first place. What's the point? Because every number tells a piece of the story, and if you want to read that story correctly, you've got to understand its purpose. This whole thing really boils down to 4 key goals. First, it's about providing the hard data, the real numbers, which helps managers inside a company make smarter decisions. It also gives investors on the outside the info they need to decide, hey, is this a good place to put my money? And, of course, there's the big one. It keeps everything legal and above board, making sure a company pays its taxes and has a clean record of every single transaction. Now, here's where it gets really interesting. Just like any language, accounting isn't one size fits all. It actually has different dialects, and each one is specifically tailored to communicate certain information to a very specific audience. Which leads us to this question: who are we talking to? And the answer is, well, it depends. Are we speaking to investors who are outside the company walls? Or are we talking to the managers running the show on the inside? The answer totally changes the dialect we need to use. And boom, here are those different dialects laid out. Financial accounting, that's the one that speaks to outsiders like investors, using super standardized reports. Management accounting is the internal conversation, the language for executives planning for the future. Tax accounting, well, that speaks directly to the government. Auditing is kind of like a universal fact checker for everybody. And forensic accounting, that's the dialect of the courtroom, used to hunt down fraud. Let's really zero in on the biggest split here. Financial accounting is all about looking in the rearview mirror, what happened in the past. It follows really strict rules so that investors can fairly compare company A to company B. Management accounting, on the other hand, is all about looking forward through the windshield. It's flexible, it's internal, and it's all about strategy for what's next. This distinction, it's absolutely crucial to grasp. So if accounting is a language with all these different dialects, what holds it all together? What keeps it from being total chaos? Well, like any language, it needs grammar rules. And accounting is built on a really solid foundation of principles and assumptions. You can think of frameworks like GAAP, that's Generally Accepted Accounting Principles, as the official dictionary and grammar guide. These rules make sure that when a company in one part of the world talks about revenue, it means the exact same thing as a company on the other side of the planet. And before we even get to the rules, we have to agree on some basic stuff. We just assume the business isn't going bankrupt tomorrow. That's the going concern idea. We assume the business's money is totally separate from the owner's personal piggy bank. That's the economic entity. We agree to record everything in a stable currency and to chop up the company's life into regular time chunks like quarters or years. These are the bedrock ideas the whole system is built on. All right, with those foundational assumptions in place, now we can get into the real nitty-gritty. These are the actual rules of grammar, the principles that guide how every transaction gets recorded day in and day out.
So here are the 4 big guiding principles. First is the accrual basis, which is a total game changer we'll hit in a sec. Then you've got the matching principle, which means you have to line up your expenses with the revenues they helped generate in the same period. It gives you a truer picture of profit. Historical cost keeps things objective by recording assets at what you paid for them, not what they might be worth today. And finally, full disclosure is all about transparency. You got to share any info that could sway someone's decision.
Okay, this one is so important. Here's the deal. With the accrual principle, if you do a job in December, you record that income in December, even if your client doesn't actually pay you until February. It gives a much more accurate snapshot of a company's performance in a specific period, instead of just tracking cash coming in and going out. But, language isn't always black and white, is it? It has idioms, context, nuance. And accounting is exactly the same. It has these gray areas where the strict rules aren't quite enough, and that's where professional judgment becomes so important.
These are called constraints, or sometimes modifying conventions, and they're not about breaking the rules. They're about applying wisdom and context when the rulebook doesn't give you a perfectly clear answer. This is where accounting really becomes as much of an art as it is a science.
A perfect example is the conservatism principle. It basically boils down to this: don't count your chickens before they hatch, but definitely prepare for the fox that might be sneaking around. You should record potential losses as soon as they seem likely, but you can only record gains after they've actually happened and the money is real.
And why do we do this? Simple. It's a built-in safety measure. It stops a company from painting an overly optimistic, rosy picture of its finances. It's all about being prudent and cautious, which, let's be honest, is exactly what investors want to see.
Let's talk about context for a second. Is $500 a lot of money? I mean, the answer is it totally depends on who you're asking, right? And that leads us perfectly into our next constraint. This is the whole idea behind materiality. A $500 accounting error would be highly material to a local coffee shop. It could completely change their profit for the week. But for a giant corporation like, say, Amazon, a $500 error is, well, it's a rounding error. It's completely immaterial. It wouldn't influence a single investor's decision. This constraint lets accountants use their judgment and focus on what actually matters. Okay, and one last thing. For this language to be truly useful for tracking how a company is doing, you need stability. You need to know that the words and methods you used last year mean the same thing this year. You need to compare apples to apples.
And that's the consistency principle. A company can't just switch up its accounting methods whenever it feels like it to make the numbers look a little better. It has to stick with the same methods year after year so that analysts and investors can make meaningful comparisons and actually spot real trends. If they do make a change, they have to shout it from the rooftops and explain why. So, to wrap this all up, here's the big picture. Stop thinking of accounting as just math. Start thinking of it as a language with different dialects for different people, a solid foundation of grammar and rules, but also these really interesting nuanced gray areas that require real wisdom and professional judgment. And this brings us to a really fascinating final thought. We've seen that judgment is a huge part of accounting, especially in those gray areas. So that leaves us with this question. If accounting has grammar rules, who gets to decide when and how they can be bent? That question is right at the heart of accounting ethics, and it's what makes this language so dynamic and so incredibly important.